Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called Unlocking Hidden Opportunities, Thriving in Recession-Tested Sectors. Transportation and logistic companies had a fantastic rally on the back of the COVID demand for goods. However, the subsequent delays in shipping and supply chains saw many companies invest to improve their systems. A lot of this investment came online just as the demand for goods was easing. Subsequently, many of these companies have sold off as a result. Today, we're going to look at a number of stocks that are attractive opportunities and determine whether it's time to get back in. Just a quick reminder, this podcast is general advice only and is not intended to be specific to your personal situation. If you do want to discuss your personal financial situation and how to improve that, you can book a call with me or one of the advice team at nucleuswealth.com/contact. At the moment, we are offering a free, no obligation review of your super. Many people I speak with are uncertain about their super. In this review, we'll give you clarity on whether your current super setup is actually appropriate for you. We'll cover how you're currently invested, as this is the most important thing that's going to determine how much money you end up with in retirement. We'll cover the fees you're paying. We'll look at the tax-saving opportunities and explain the rules of the game so you can take advantage of those. Again, you can book a call with me or one of the advice team at nucleuswealth.com/contact. We are live every Thursday at 12:30 Australian Eastern Time. So jump on the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. We are also available on all other major podcast platforms, so feel free to tune in there if you prefer. Today, as always, we have Nucleus Wealth's Chief Investment Officer, Damien Klassen. Damo, welcome.
Hey, Sam.
My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Damo, today, let's just get straight into it. So over to you.
Yeah, sure. So look, so title this looking for opportunities in recession-tested sectors. And what I'm really talking about here is if we're worried about markets falling and you're worried about sort of overpriced and earnings still having to fall, one of the tricks you can sort of use is to look for sectors that have already been through the initial stages. So where are the sectors that have had some reasonable falls in terms of profitability, and then sort of digging through that and trying to work out, well, what's the outlook look like? Where are they in their cycle? Have they already reached the bottom or close to the bottom? And so therefore, you won't get the same sort of share price falls that you get in other sectors that might be still peaking and earnings really haven't tumbled yet. So what we thought we'd have a look through was just the logistics sector, and it's quite an interesting sector in many different ways, and lots of different things going on all the different parts. And just to sort of give you, I guess, an overview of where some of these, or I guess what our thinking is in terms of some of the sectors. So I'll start with with a graph to sort of showing where the logistics market actually actually is. So this is data sort of coming out of a Goldman Sachs piece, but effectively what we're looking at is, and a few different sources from companies, but we're sort of looking at about $11-12 trillion for the sort of global logistics market. About 2 of that is in the US, so it's actually sort of a smaller share than what you see in a lot of other industries. So the US isn't anywhere near as big. But I think it's probably not too dissimilar in terms of some of the geographic outputs that you see. So, and obviously, $2 trillion in the US is still very, very big. And I guess the logistics market does have a lot of private companies within it as well. So as we sort of looking through the world, there's, say in terms of shipping, a lot of the shipping companies are privately owned. And you go through some of the biggest sectors that's within that US market, and so a lot of those there's quite a lot of private ownership as well, and quite a lot of small operators in it. So the biggest segment of that logistics market is the trucking side, and that sort of makes up a huge. Well, sorry, actually, I should zoom in on that graph so I can actually read the numbers. So that, yeah, sorry, it's about it's a bit under $1 trillion is in that trucking market, and then you split up into rail, air gets a lot smaller. But the thing with the trucking market is that is full of quite small sort of owner operators, and so so as you dig through that, that there's a the what's affecting it can vary quite significantly between the listed companies which you can actually invest in and the unlisted ones. And then you've got all the storage and the and sort of the sort of REIT side of that as well. So that's sort of a broad view of what's happening there. I think the other things I want to note is that there is a lot going on in terms of supply chains. We basically went through some really high prices for transport, but we also went through this period where the US is doing a lot to try and reduce its supply chain dependence upon China. And so, and it's been successful. So China's still exporting a lot, but in terms of if you look at US exports, the amount coming from China has fallen from close to 18%, sort of during the I guess the Trump period and at the start of the Trump period, and then falling, as tariffs and everything came on. But certainly the trend is still very much down. And now the amount of exports coming from Mexico is actually higher than the amount coming from China. And so that means that there are differences happening in terms of supply chains as well. So where these products are coming in is going to make it is changing as well as sort of other trends that we might be seeing. So that's going to affect the sector. The other big factor is ESG and a lot of the carbon, the push to carbon neutrality. So if you look at the different modes and what it means for carbon costs, it's actually not that dissimilar, I guess, to the actual cost of delivering by these ones. In that maritime is really, really cheap. So when you've got a large ship and you've got a lot of containers on it, your actual per unit cost is really, really low. And the amount of emissions that come out is really low as well, per unit. The thing is, though, you're often carrying these a lot further when it's via maritime, and then the other end you've got the road transport where it's most significant. But there's changes within all of those, and I'll jump in individually as we run through some of those. But certainly maritime, for example, there's a lot of new emission standards coming on, and so that's sort of affecting what ships can do, how fast they can go, and because sometimes it's a matter of saying, well, if you're only allowed to produce so much in terms of emissions, you can either overhaul and change the fuel sources and do things like that, or often the other choice is just run the ship a bit slower, and that can often bring down the levels to meet the standards without having to do a lot more on that. But those standards are tightening up over time. And then road, we really haven't seen a lot in terms of the sort of mandated changes. There's a lot sort of happening in the electric area on the road side, but that's still, I guess that's part of that the electrification chain we're seeing, and they're probably a ways away down the track, especially given that the road, well, in all these cases, is that your existing vehicles will last a long time. 10 to 15 years, I think, for most of these, and easily over 20 for some of them as well. So that's one. Another thing, so the oil prices certainly spiked up recently, but I just want to highlight that when we're talking about oil prices, generally speaking, the problem falls on the customers, not on the actual companies involved. Often the companies actually make better profits with higher oil prices. So they have surcharges, and those surcharges are over and above what they actually need. So I've got a chart up to sort of showing this is some trucking companies in the US, a bunch of ones, and just showing that they actually as as their price goes up, they actually manage to make get back more than what the price rises are.
Yeah, Damo, I just want to add there as well. The chart on that, the title on the chart could be a little bit deceptive. Oil price falls on the customer. We're talking about rising oil prices.
The effect. Yeah, the oil prices. The effect of oil prices. Yeah, is borne by the customer. Is really a better word. Yeah, it's borne by the customers, and more often than it's borne by the companies. So that's our sort of big picture. What's going on, and then I thought I'd start with shipping, because that's where we've seen the most extreme cases, and I guess this is the question. This is when you look at these charts and you're like, okay, your global shipping rates went from $1,000 or $1,500 a container to sort of 10 or 11,000, and they're pretty much back to those levels that they used to be at. What does that actually mean? So have we seen have we seen that effect come through on companies? And so if that's the case, and we are going into recession, and these shipping rates have already fallen, 90%, how much further can they fall, and what's the effect on companies? So I'll start by saying the issue is that these are the spot rates, and what we generally had, and this is not just the shippers, but also a lot of the other sectors as well, is as the shipping rates and transport rates really skyrocketed and sort of went up 5-10 times, what companies tended to do was try to lock in longer time frames. So what customers would do is they'd go, my cost has just gone up 5 times. I can't afford for it to go up another 5 times. So I'm going to try and lock in some prices with the shipping companies, so that I don't have to worry about, they might go up 20 times or 30 times. Now, what that means is, while we have had, considerable falls over the course of this year, not all of that has flown through to actual prices. And I think what you'll find is a lot of this, so there's a lot of people are still on the old prices, and that's going to take another year or two to roll off before we actually see that effect come through in terms of customers. So the shipping companies are still making very good money in terms of the returns they're getting. The forecasts are for them to keep tumbling, and I think as well, in ballpark, I think they made more in the last 2 or 3 years than the 20 years earlier combined. So there's been they've done very well out of it, but then the question is, are we going into so one is, we haven't actually seen the full effect come through the financials yet, and the second part is the shippers have this very classic boom bust cycle, and it's usually quite long term. And so I've just got another chart up, just sort of showing the some new vessels and sort of forecasts in terms of what's expected to be or what's on order and what's being delivered. And basically over 2023 and 2024, these are real boom years in terms of more than twice what we've seen in some of the prior years is new ships coming through. So basically shipping companies are using their money that they just got to go out and buy new ships and expand their fleet. And a lot of those orders were placed, when shipping rates were a lot higher. And so, that's, you're basically looking at low prices, and at the same time as we've got low prices, we're going to see this massive increase in terms of the number of ships that's coming on. Now, not all of that is, or actually, I think this one I've got up is some of the container ships, but we've got a similar thing going on in terms of oil. So the oil price that really spiked as well, and that was different in the cost of delivering oil really spiked, and that was different in that was largely that the Russian oil, the constraints on Russian oil following the Ukraine war, and now that meant that Russian oil, rather than spending a couple of weeks getting to probably a week or two getting to Europe, Now they're spending 6 or 8 weeks or longer to get to other places in the world to produce. So they actually just need a lot more ships, and there's a lot more oil sitting on ships, and so there's been a significant increase as well in terms of those.
So Damo, just a question: with the spot price coming down so much and this excess added supply coming on, do you think shipping rates are going to go down, or do you think we're sort of round about the bottom and that's a sort of floor in the market?
Yeah, well, and that's exactly where what we're looking at is that's your key issue. Look, I think there's further to fall. I think this sector has got a very classic capex boom bust sort of cycle that it has, in terms of you get some reasonably high shipping rates. Well, in the usual, forget the last few years. Ordinarily, what happens is you get some reasonably high shipping rates. Everyone goes out and orders new ships. All the new ships hit at the same time. All of a sudden, there's all this extra capacity comes on. Quite often, those orders will happen. So on this graph, for example, we can see that 2006 through to 2008, there was all these, that was a similar type of, double and triple the prior years. And so all these ships are arriving just as the financial crisis is starting. And so where we see it, and at that point, demand takes this big hit. And so, I guess what I'm saying is it's fallen 90%, but it can still fall further. And I wouldn't be on the price of shipping. There's still quite some significant risks in terms of that. If you hadn't have seen this, if this chart wasn't so the spikes weren't so high, then you'd go, okay, maybe I'm a little bit more confident that the shipping rate might be closer to the bottom. But it's a very classic boom bust. Everyone buys lots more capacity at the wrong point of the cycle, and then once you've got a new ship, you spend a lot of money to get it. They will usually try and run them at whatever rates they can. So they'll sort of run them at loss-making rates, or what might seem to be loss-making rates, in order to keep them keep things ticking over.
Yeah, and this seems positive for the transport industry. I'm just curious, what sort of makeup, does the shipping, within that industry, compared to sort of road and other forms of shipping?
So it's positive for people who are buying. It's good for saying yes, but it's not positive for the companies involved, I guess. So I've got a Maersk one, which is the biggest one, and that's I guess the question for these ones is. So if you look at their earnings, there's the blue line's the actual earnings and the red line's the forecast earnings, and you can see that the blue line's still really high. But the forecast earnings have really taken that tumble. That's a 12-month forward earnings, and so and they're not that cheap relative to some of their history. So I guess what I'm saying is, if we're looking in this place as one place to go. Where can I find companies where sales have already fallen 90%? So companies and forecasts have fallen considerably. Can I come in and pick up some bargain basements in this? I'd be saying not yet. There's still a lot of risks within this, and we still don't know how this capex cycle is going to play out. It looks like it could be it could be just a classic. You've got a lot further to fall. Yes, it's fallen 90%, but it's back to similar levels that it used to be, and it could fall another 50% from here, and you still be sort of at levels that you've certainly seen in other recessions. So
and what sort of time period do you think all this extra supply and shipping is going to take to actually come online? Are we talking?
So a lot of it's coming this year into 2023. You'll get an even more into 2024. So if even just a slowdown in it, well, you don't even need a slowdown in the economy with the amount coming on. If you don't have a booming economy, then shipping rates are probably going to fall further, because there's just a tidal wave of supply of these coming on board. So and I think in terms of as I said, if you looked at the total amount of shipping availability at the start of this year, and then you looked at the forward order books, there's basically another 30% of new shipping coming on over sort of a 3 or 4 year period. So there's a lot.
Yeah, a lot.
And keep in mind, and shipping is a very volatile industry in terms of profits. So, it is that part where you do want to say, okay, I want to be buying these things when there's blood in the streets and everyone's worried that no one's ever going to make money again in shipping. And I guess what I'd be saying with them is, I think from my point of view anyway, it still seems a bit early for that, unless you have a quite a strong outlook on the economy isn't going to go into recession, or it's going to turn around and you get that more of a pickup. And you also do have that whole China. If there's less goods coming out of China and more coming out of Mexico, then there's less shipping, particularly to the US. And less out of China and more out of Eastern Europe or something like that as well might be the case. If you're looking at builders, so ship builders, it's quite hard to get exposure to. Well, sorry, it's not quite hard. It's in developed countries there isn't a lot of exposure. The biggest European one I think might be under $1 billion in terms of market cap. So it's a relatively small company, compared to most others. And most of the big builders are all a lot of Korean and a lot of Japanese, but they tend to be very, very big conglomerates. So Sumitomo, heavy industries, Mitsubishi heavy industries, Hyundai, Samsung, the heavy industry, and all of them, that's the heavy industries flavor of those companies, because they do have multiple listings. And they all, so they're all such big companies that, if you're just trying to get onto the shipbuilding part, one that's already sailed and it's already factored into these guys, and it's a small part of the bigger companies. So and the other thing to note as well is just Panama Canal is actually having some droughts and so reduced the shipping capacity through there as well. So a few more. So if we move off shipping and go, okay, well, what's the sort of next? Well, let's look at the biggest part of the US, the trucking part. So that's where again we had this spike, and so depending upon how you measure it, I've got two different measures. One's this from Cass, their freight rates, and so we've certainly come well off the peak. So freight rates were sort of 225, say, pre-pandemic, and maybe 250 in the few years just before it, and they went to sort of almost $4, and now we're back to $3. So they're certainly well off their peak, but not back to where they were before. Maybe inflation and a few other things, you might go, it's actually more reasonable. If you look at FreightWaves, which is a company that sort of does, I'm just using one of the truckload indexes, and that's sort of reverted back to the pre-pandemic numbers now on their case. So trucking is the other thing I want to note with the trucking side, though, is we've had quite a big bankruptcy in the US. So a company called Yellow, which was one of the larger suppliers, I think it's 30,000 employees, have quite heavily unionized, has gone into bankruptcy. So there was a bit of a union sort of standoff in terms of how much they were going to charge for, how much they were going to push through in terms of wage rises, and effectively, that sort of sent customers fleeing to other suppliers, and eventually the company went broke. Even though I think we didn't even get to sort of union shutdowns, it was sort of the threat was enough to send some customers elsewhere. And so what that meant was we actually had a bit of a spike in terms of prices coming out of that. And that's still sort of flowing through a few different sectors within the economy. It started to fade off a little bit this month, but the question there is, the real question within trucking, and particularly the US market, is so we've had falling rates, and they look like they might have reached the bottom. But is that because we just had this big company fall over, and so everyone else is picking up market share, and we've just taken off a huge amount of the market, and then but that underlying trend line is still in place, that we've got falling volumes, and particularly if we're going into a recessionary area, and then there's further to fall. And the issue is within the trucking is the market structure of this is that there is a lot of small players in this market, and it's really easy to get a trucking license. So you can get yourself I think it's the most popular job, or not most. It's got the largest number of people doing that job in something like 30 or 40 different states in America. The number one occupation is a truck driver, and so it's quite easy for people to come into that market. All you need is a truck. There were these huge rates that everyone was getting over the last few years. So a record number of new entrants sort of all entered the market all at the same time, and they're all sitting on, they spent whatever $100,000 to get themselves a truck, enter the market, got these great rates for 6 months or a year, and now the rates have just tumbled, and so you've got a lot of people sort of sitting there working out when they're going to pull a pin. So they might be running, and a lot of them, especially if they're owner operators, which most of them are, they're probably sitting there running at a loss, or running just at a very, very low salary for themselves. So once you take out the interest costs and all these things on the truck, maybe they're working at well below minimum wage, but they don't want to have to go bankrupt, and so they're sitting there until until they absolutely have to. So so it's a sort of it's an interesting market structure. And some of the companies within it are still making reasonable money. And so what was I going to talk about there? Oh, sorry, goods demand is the next part. Is there further fall on goods demand? And there's some technological changes coming down the proverbial highway. Driverless trucking in particular is probably further away though than what we're seeing in terms of the driverless cars. So driverless cars, there's some live trials in a number of different states in the US, and it looks like that's really picking up steam and has sort of reached a sort of more critical level. The trucking side does seem to be some time away. So California, for example, which has opened up San Francisco for driverless cars for for Google and for Cruise to do basically what they want to do there. At the same time as put through a ban on driverless and making sure that they've got, or they put through something making sure that any driverless trucks have to have somebody there. So there is technological change coming, but sometime down the path.
Damo, just on the technological change, within the transport industry, the move from oil-based to renewables, what sort of impact do you think that's going to have on the profitability of the transport sector?
Yeah, so that's generally a good thing at this point for a lot of the shorter haul. So if you're a postal truck or a delivery truck, and you've got a relatively set route, where you're going, and most of those I think are doing 150, 200 kilometers a day at max. Those types of things are actually perfect for electric vehicles. You know where you're going to be, you know what route you're doing. You don't need like a massive battery in it, so you only need a relatively small battery. Those are profitable already, and as they're rolling these out, there is cost savings for companies within that to make genuine savings there. And then as well, there's a lot less servicing on these, and these are big vehicles, and they can and they get run a lot, and so the servicing costs can really add up. So there's going to be some very good cost savings for that front. In terms of the long haul stuff, we're really not there. You just don't have the battery technology hasn't reached the right level, and then in terms of cost, there's a number of sort of promising things out there, and for trucks, some of the swappable batteries seems to make a bit more sense. You basically drive a forklift in and drop the battery in, and then pull the old one out first, and then drop the new one in, and off it goes. But that's still that's not there's certainly technology out there, but I wouldn't say that's in any way imminent. Whereas the short haul trucking is here, it's ready to go and profitable. So I do think there's that, but keeping in mind that this is going to take a long time. Like a lot of trucks, can be 15, 20 years old easily, and so it will affect it, but it's still at the margin. So if we're looking at these trucking companies and some of the ones that sort of the better ones, Old Dominion or JB Hunt, I've got a few of them up there. So earnings have really only fallen a little bit, and actually Old Dominion, which is sort of one of the better quality ones, really only stabilized its earnings for a bit there, and forecast earnings have actually started to tick back up again. But they're not cheap. Even on these earnings, say Old Dominion is sort of on almost 30 times earnings. So and most of the rest of the sector is somewhere between 15 and 25 for a lot of them. So industrial companies, I certainly feel more comfortable buying them at a discount to the market, and especially if you've been through this relatively big boom in terms of earnings, and for say Old Dominion, earnings are up, I don't know, maybe at least 50%, probably closer to 100%, over the last few years. And if you're paying for a company that's priced at sort of 30 times earnings, and on a cash flow basis almost 50 times earnings, you really want to expect some good growth out of it. And that's so. There's some companies there I've certainly got on my watch list of like, these are the companies I want to buy, but I'm just not interested at these prices. So I guess still waiting for that trucking shoe to sort of hit the listed companies, to drop and sort of hit the listed companies yet.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
So air freight is sort of similar in terms of that's been through the full cycle. That's I'm showing this is a price index from the Fred database, and it doubled and then halved, and so sort of we've done the full round trip, and it's back to sort of similar levels to what it used to be. If we look at the two big players in that is FedEx and UPS. Now FedEx just reported overnight, and it's a great sort of microcosm of what's really going on within this sector. So revenues were down 7%. Operating profit was up 29%. They've got a few different areas in it. Their ground operating revenue was up 61%, while their freight was down 26%, and they're downgrading forecasts. And the share price rose 4 or 5% in aftermarket. So it's just this part where there's just some parts of the business are booming, other parts are falling. A lot of the ones that are booming are actually that they've managed to get their costs under control. And so they've managed to keep their revenues, or the revenues have been falling, but they've actually managed to do much better on the costs. And so there are a lot of moving parts within these. You've got goods demand, which is still relatively strong, but so that that could be falling, or that could make a difference. I think these guys are going to be affected a lot by driverless, and they're all trialing different things, and that could really make a huge difference to their costs. But at the same time, there is that's probably some time away. There's probably the part about actually, so when I say some time away, it might only be 2 or 3 years away. It's hard to tell. It's Google and Waymo have got paid taxi services in San Francisco operating right now, where you can jump in a taxi and there's no driver and it drives you wherever. Are we close to the stage where that car, somebody fills the car up with, packages in some way, and then that car turns up at your front door, and you get a message to come out and collect your package from the package from the car. That feels like it's still a couple more years after that. I think there's but they're all certainly working very hard on these, or they're working on systems where one driver drives the car out, parks it somewhere, and next thing drones start, and puts packages in drones, and they come down and airlift them onto your front balcony or whatever it is, or ones that walk along the footpath and come to your house and do it. So there's lots of stuff they're trying to do on that. So there's lots of technology change coming. Amazon's also trying to make a big push into this sector. And some of these are quite heavily unionized as well. And so, keep in mind that we're going through at the moment within the US, there's all the major car makers are going through this rolling set of strikes where the unions are basically, they're pushing for a 40% pay rise over the next 4 or 5 years. And the both major parties are out trying to help the unions. So you've got the Democrats, which are traditionally the party of the unions, and so they're sort of trying to support more wage growth and that part. And and Trump's certainly chasing that. A large part of his voter base, are unionized workers, and so the Republican Party, which traditionally would have been more on the side of the businesses, is actively chasing those votes. And so there's the potential for more disruption and higher wages within this. So within that part, if we looked at the earnings of, say, of UPS and FedEx, they have started to tail off. They haven't they're not back to the prior, for UPS, they're not back as far as pre-pandemic levels. FedEx probably more so. They sort of had some big falls in sort of forecast earnings last year. But what that's meant is that FedEx sort of got its problems over more than a year ago, and UPS has sort of been digesting some of its problems. These are much more reasonably valued. So, FedEx and UPS is on sort of 15 times earnings, and versus the market, industrial market closer to 20 in the US, and FedEx at 13 times. So they're trading on quite reasonable discounts to the market. So they're not expensive. UPS gives you a 4% yield on the dividend, so pretty reasonable in terms of that. The real issue is, have we reached the bottom of this cycle? Look, I don't think so, but I think it's getting close to the point where you'd say a fair amount of the bad news is into these stocks, and the price isn't unreasonable, and so it might not be a winner over a year or two, but over a 4 or 5 year period, you might be a bit happier with that purchase. I do want to highlight though that they don't look as why we haven't put these into our portfolio, or these types of ones into our portfolio yet. Partly on that recessionary issues, but also the cash flow still doesn't look that good. So they look good on a profitability basis. It's just an issue about they've spent a lot on capex, and they've spent a lot on trying to streamline their the supply chain issues and really get these deliveries out faster. And so the question, and that's meant that their actual cash flow, because they're doing all this investment, their actual cash flow has been quite low. And so the question is, have they reached the end of that, or actually are we still going into this period? And are we going to see that, as Amazon keeps throwing more and more money at these, is that they're going to be competing on a technology front for some time yet, which is quite possible on that front.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the... Just one more quick thing. We just want to ask you for a simple favor. We want to spread the message about integrity and transparency in investing. At Nucleus Wealth, we live and breathe these values and would like you to help us spread the message. Subscribing to our channel will help us do that, and we'd be most grateful if you hit the subscribe and like button now, as it helps us far more than you may realize.
Okay, so what are the sectors, what are the parts of this industry where you're not facing some of those issues? Is the freight forwarding, some of the freight forwarding companies, and some of the people involved in other parts of the logistics part. So companies like WiseTech that provide a lot of software to this area. So I guess what I'm saying there is, and I probably will butcher the name. Kuehne Nagel, I think, is what YouTube tells me. You know, you always trust YouTube. It's is how to pronounce it. But so they're a very big freight forwarding company, and there's a bunch of other ones that are out there as well that are listed, and so they're very asset light. So what their job is basically, you know, you need to get something somewhere. You don't really care whether it goes on a ship or a plane or a truck or what the whole process is, and it's their job to organize that stuff and get it done for you. So the shipping industry, and part of the reason why we had all these problems, the whole logistics industry and shipping in particular, is surprisingly antiquated. And you know, there's a lot of stuff about you know, it's not just turning up and saying, here, I've got my container, can I put it on this ship, and can you send it from wherever to, you know, LA to Australia or whatever it is. It tends to be, you need to know somebody who's going to do whatever it is, and you've got to send them a fax or whatever it used to be, that and fill things out in triplicate and all those. It was actually quite surprisingly, you know, very much done in technology that was from a long time ago. Now that technology has been going through a major overhaul over the last few years. So these it is going to be get better, but there are still some very clunky elements to it, and it certainly hasn't you know, improved to the stage where you'd expect from, you know, from other industries, from looking at other industries. And so I do think there's still going to be a lot more gains in terms of there's a lot more gains in terms of cost savings on this front, and I think there's a lot of the artificial intelligence side really helps some of these, because some of these problems they're massive problems. You know, for anyone who's been involved in looking at sort of mathematical problems, you know, one of the traveling salesman problem is quite a common one of saying, you know, what's the most efficient way to get between these 20 or 30 cities, and it sounds like it should have a simple answer, but they can actually get really complicated. And that is exactly the problem that a lot of these freight forwarders are facing, and a lot of the you know, the people actually involved in the logistics. And so the work within making AI tools a lot more accessible, I think, is going to create a lot of savings in terms of these, and some of them are going to be in non-obvious ways. Is that, yeah, actually I've got a package. Actually, if I send it in the opposite direction to what it needs to go, it'll actually get there faster, because whatever it picks up and then ends up in a different stream. And yeah, so there will be. I do think that AI is really going to help these guys. They are very asset light as well, which is different to a lot of the other parts of the sector. And what I mean by that is, if you've got parts of the sectors like the shipping part, where you own these massive assets and everyone else is building it. You know, I've got this ship that's earning these great rates still because I locked them in from a few years ago, but everyone else is flooding the market with new ships. Is that I know my rate's going to come down over time. Whereas these guys don't have the same. They don't own these massive assets. They don't own a big asset and are trying to make this return on it. They're it's more of a service company. And that's so these guys, a whole bunch of these other freight forwarders, a company like WiseTech as well. The issue is for all these guys is they're not quite cheap enough for me. these guys are certainly, they're all on my, not all, but I've got a number of names of these that are on my watch list. Some of them, I've owned in the portfolio in the past, and more than happy to own again. It's just that they do look better on a cash flow basis. So these guys actually look cheaper on a cash flow basis than what they do on a sort of earnings basis, which is the opposite to what we saw in FedEx and UPS. And so, certainly an area of the market where, as we start to reach the bottom, this is sort of where I think we should be looking. I think it's probably a little early still for this one. We do have WiseTech in the portfolio. That's very expensive, but again, it's sort of, that's a bit of a growth story, I guess, and still in an area that we're not as concerned about. And it's had some reasonable price falls recently that make it a lot more attractive in terms of that front. So so I guess what I'm saying within this sector is, I don't think it's quite there yet, but it is a place I do want to be looking as the cycle progresses, and looking for the companies that are more asset light. And then the asset heavy ones, absolutely be investing at some point, but you really want to see the blood in the streets on those ones. And despite 90% falls in freight rates, we're just not there yet on that front.
Nice one, Damo. So now we have our question of the week. This is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, how far are we off a bottom in the transport sector? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. Damien, I just want to add as well, as the viewers would have heard, we have around 100 different screens and tilts that the investors can utilize across all the portfolios. With the screens, you can screen out the GICS industry group transportation, and with the tilts, you can add that sector in as well. So depending on where we are in the cycle and your view bullish or bearish, you can either add or subtract that theme to all our portfolios. So are we done with the investment implications?
Well, I want to talk a little bit sort of big picture investment outlook, because I think the key I want to harp on again is that any investment it's a matter about price. So you do need to get the fundamentals. The fundamentals need to help, but really it's about the price for those fundamentals. So you can have companies that have got great earnings, are growing really strongly, but they can just be overpriced. And so regardless of how well the company grows, you're just not going to meet that. And the poster child for that is Cisco. Middle of the tech boom. You sort of looked at this company and you're like, it's great. They're providing all the infrastructure for the internet. They're really high quality routers. And as the internet grows, these guys are just going to grow. And you look at their earnings over the last 20 odd years, and the earnings are up 10 times higher than what they were. And it's just this nice, steady 45-degree line up. But if you had bought it in the tech boom, you're still down 20 or 30% on your investment, because the price was just so high. So despite the great fundamentals for the last 20 years, you would have lost money. If you bought it at that peak. And so I don't think the transport sector is quite the same, but there is this element of saying, I need to make sure I'm lining up the fundamentals with it. And you can also look for companies where they're just so cheap on some measures that despite some negative outlook, they might be they're going to shrink earnings for the next 3 or 4 years. But if I can pick them up so cheaply that I don't actually care, because on the other side of that, I'm going to get a good yield to hold it, and on the other side of that, you'll see some growth. Then they're the types of companies I like to add as well. Within the portfolios at the moment, I do think this transport sector is one of these ones that if this cycle extends for another 3 or 4 months or 6 months before we start to still see some real economic weakness, and we do keep seeing weakness in this transport sector, then this is one area I think there could be some safety, but at the moment I don't think we're there yet.
Nice one. Thanks, Damo. Nice wrap up there. And I'm sure we'll continue to tell the story as things unfold. So that pretty much wraps us up for today. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below, or send us an email to contact@nucleuswealth.com. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them. So, from myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.